Closing bell, take a look at how the bond markets are shaping up in today's session. Of course, we had a lot of supply coming onto the market, so we did see the prices rise today. Today's $40 billion two-year note offering, in fact, bringing some solid demand, but it does come on the heels of Monday's Treasury auction of $8 billion worth of 20-year Treasury and inflation bonds. So are Treasuries still a viable option for investors, or is your money better parked elsewhere? Don Galante is Senior Vice President of Fixed Income at MF Global. David Castillo is Managing Director of Taxable Fixed Income Trading at Further Lane Securities. CNBC's Rick Santelli, of course, joins us for this discussion from Chicago. Great to have you all with us.
Thanks.
Don, let's start off with you. We've had certainly a lot of supply coming onto the market. We are going to see plenty more supply in order to pay for the stimulus plan in the future, in the coming days. Why should investors even think that this is a place to invest?
Well, I mean, I think the bottom line is that we saw a nice rally driven really by a flight to quality that ended in sort of December. And we look at the 10-year note, for example, we saw a yield of 212. We've had a healthy backup. We've moved back to almost 40 basis points to 50 basis points range. And as we see more supply, there's an opportunity here to add to quality paper. So if you're concerned about the economy over the next year or so, and you believe that it's going to take a while for the economy to come back, these kinds of levels are not necessarily bad, although they are low on a historical basis. But if you look at a funding rate of 0 to 25 basis points, and you have dollars and you're looking for an alternative, treasuries are a safe place to put it for the time being.
Certainly a safe place, but, you know, David, when you look at the landscape of fixed income out there and you take a look at the yields that are available to investors, are treasuries really the best place right now?
Well, I got to tell you, I'm very hesitant to recommend anyone buying generational, if not all-time lows relative to treasuries. No longer have they become a fixed income instrument where you're relying on the cash flow stream to get the returns that you're hoping to get. Really, the treasuries at this point have become more of a safe haven commodity by which people who have dollars have a place to use as a storehouse for value. And you're paying a pretty significant price for that. If you assume the rate of inflation is approximately 2%, regardless of what your funding costs are, it's not necessarily the most attractive place to play. And in the meantime, your opportunity costs for other opportunities in the market are significantly greater. If your only need is for liquidity in the marketplace, certainly treasuries are the most liquid market on the planet. If you want to move away from that, though, there are agency mortgage-backed security obligations, which at roughly yield you 4.5%. There are the new FDIC guaranteed back notes, which are trading at a significant spread to treasuries. So there's many alternatives that I could go into in depth that are more attractive from a fixed income perspective.
Rick Santelli, help us piece together these two data points that we have about the recent offerings. Pretty solid demand on the two-year notes, tepid demand when it came to the 20-year TIP auction. How do you assess investor demand for treasuries these days?
Well, I'd be careful on using the word tepid for the 20-year. You know, it's complicated because we have this deflationary issue. Just look at housing prices, but it's probably going to be a transient guest that will go home someday, only to welcome inflation down the road. Plus, tips are kind of an oddball. They're not the most liquid. They're not the most investor favorite when it comes to trading, and all of that gives a price of liquidity. Generically, all the auctions have been good, maybe too good. And it takes me back to whether it was housing prices going up, free credit abounding. This supply that finds limitless buyers, this type of arrangement is going to end. And when it does, the further out on the curve you are, the more in danger you're going to be about a price cave-in. Even though treasuries look pretty good now, you need to be a bit safer now, but at the end of the day, maybe safety should be limited to two-year maturities down to T-bills if you're truly looking a year ahead.
Those are very interesting points, Rick. Don, what do you believe in what Rick Santelli said in terms of danger further out on the yield curve, and given that, your recommendation to investors as to where they should be investing in treasuries?
I don't disagree with what's been said. I mean, depending on what your appetite is, that is the truth and that's reality. The one thing I'll say after trading in treasuries for 29 years and watching multiple cycles, there's always a bid for treasuries on the screen, so you can always get out at a price. And the credit markets in the last 4 months have been very difficult. So opportunity is there, and if your alternative is zero and you want to sleep at night and be comfortable, treasuries are there for you. I'm not saying you want to stay in treasuries forever, because I think at some point, I agree with what's been said here. As the economy comes back, there'll be a fear of higher rates, and then you might want to walk into or move into the credit world. But for right now, if you want comfort, Treasuries are the place to be, and I think the bid's there on a global basis.
Don, what are you watching, though, in terms of that signal that will let you know that it is time to walk into that credit world?
I think it's the economic numbers. You got to look at housing, you got to look at employment, you got to look at the stock market, and it takes time. Bottoms take time. The last time we were down this low in interest rates, we were down here for a year and a half, in 2003 into 2004, before the Fed started to take action again. And we just got here. December was the last ease. So, to me, it's consistent. And again, I don't disagree with what's been said here, but I think if you want to be comfortable for the time being it's January, I think you can easily use the backup we've seen in the last 6 weeks and buy into the auctions.
Okay, going to leave it there. Don, David, and Rick, thanks so much for your time.
Thank you.
Thank you.
And we got just about 10 minutes to go before the bell rings. On Wall Street, we've got the Dow.